Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories in corporate filings. And today we are diving deep into the Procter & Gamble company's latest quarterly report, where we will see if their consumer staples are really as solid as their stock price suggests. Let's start by looking at the very top line of their business, the net S. Ales, and see how they are performing over the last couple of quarters. Their net sales overall for the 3 months ending in September of 2025 came in at a hefty $22.4 billion. This is a solid jump of about 3% from the previous year. That might not sound like a lot, but for a company of PCYG's size, even small percentage changes translate into huge amounts of money. Digging a bit deeper, we can see how different parts of their business are contributing to that sales growth. Now, this table gives us a fantastic breakdown of what's driving those sales, it looks like. Price increases are contributing about 1%, and a favorable mix of products is adding another 1% volume. The actual number of units sold was flat, but remember, we are also seeing a 1% boost from favorable foreign exchange rates. All of this adds up to that 3% overall increase. The company is very good at explaining what is happening in. Their numbers let us look at the gross margins, which tells us how much money they are making on their products before other expenses. The gross margin for the quarter was 51.4%. This means that for every dollar of sales, about 51 cents are left after accounting for the cost of making the product. Now, this is a little down from last year when it was 52.1%, so they are making slightly less profit on each item sold. The report goes into detail about why this happened. They are seeing around 1% less profit due to things like unfavorable product mix, meaning they are selling more of their lower profit margin items. Also, product and packaging investments are cutting into profits, tariffs are costing them an extra 0.6%, and foreign exchange rate changes and higher commodity costs are also playing a role. But it is not all bad news. They are getting about 1.4% back through manufacturing savings, and the higher prices we just talked about are contributing another 0.5%, so they are working hard to claw back some of those margin pressures. Now let's shift gears to what really catches the eye: earnings. That is what investors and the market ultimately care about the most. For the 3 months ending in September 2025, net earnings attributable to Procter Gamble were a staggering $4.8 billion. That is a huge 20% increase compared to the same period last year. That is serious growth. And when translated to earnings per S-share, which is how much profit is generated for each share of stock, diluted earnings per S-share or EPs increased by 21% to $1.95. This is a really strong indicator that the company is becoming more profitable for each share. But the company also talks about core earnings, which they believe better represent their ongoing business. Core EPs increased by 3% to $1.99. So while reported earnings jumped 21%, the core business growth is a more moderate 3%. This difference is important because it tells us that some of that massive jump in reported earnings is due to factors they consider temporary or non-recurring. Let's quickly look at what is called incremental restructuring to understand this difference. The company mentions that they are incurring extra restructuring charges that go beyond their normal level of costs. These are related to a new portfolio and productivity plan they announced, and also some prior restructuring in places like Argentina. The difference between the reported earnings and core earnings is significant and highlights the impact of these one-time adjustments. The report also gives us a look into their operational cash flow, which shows how much cash the business is generating from its day-to-day operations. Operating cash flow was $5.4 billion for the period. This is an increase of $1.1 billion from the previous year, which is a fantastic sign of a healthy and growing cash-generating business. They also talk about adjusted free cash flow, and their adjusted free cash flow, which means the cash left after all expenses and capital spending and excluding some tax payments, was almost $4.9 billion. They are incredibly efficient with their cash generation, boasting what they call an adjusted free cash flow productivity of 102%. This means they are generating more cash than their net earnings, which is a very strong metric. Now let's zoom into specific parts of their business, the segments they break their business down. And this is where we can see how brands like Pampers, Gillette, and Tide are performing. In the beauty segment, net sales increased by 6%, driven by higher volume, and pricing and grooming sales were up 5%, with pricing and foreign exchange being the main drivers. Healthcare saw a 2% increase, but volume actually declined slightly. Fabric and home care also saw a 1% increase, but with lower volume, baby feminine and family care saw a 1% increase as well. This segment reporting is crucial because it helps us understand the health of individual brands and categories within the larger company. The beauty segment is doing particularly well with strong growth in hair care and personal care products. It seems like their innovation and pricing strategies are paying off here. Grooming is also showing solid growth driven by innovation and pricing, though they are seeing some competitive pressures in certain regions. Healthcare is a bit more mixed, sales are up, but unit volume is down. This suggests they are relying more on price increases than on selling more products, which is something to keep an eye on. Fabric and home care saw modest growth, but again with a decline in unit volume, foreign exchange and pricing are helping here. But volume is a concern. And baby, feminine and family care showed a 1% sales increase with volume being flat price and product mix. Our key drivers here not necessarily selling more units. The company also discloses risks and opportunities, which is always a fascinating part of these reports. One of the major risks they highlight is the need to stay ahead of the curve in innovation and adapt to changing consumer behavior and new technologies. This is a constant challenge in the fast-moving consumer goods industry. They also point out the risks associated with global economic volatility, geopolitical tensions, and unpredictable government policies, not to forget disruptions in supply chains and rising commodity costs. These are all external factors that can significantly impact their performance. Looking at the market risk section, it's clear that P&G is actively managing its exposure to interest rates and currency exchange rates. They are using a significant amount of derivative instruments to hedge against these risks. These are essentially financial tools to protect them from losses due to fluctuations in currency and interest rates. Now for my take on this report, Procter & Gamble continues to demonstrate remarkable resilience and pricing power. They are successfully navigating a complex global economic environment by increasing prices and optimizing their product mix. This allows them to maintain or even grow their profits even when unit volumes are not growing significantly. Their strong free cash flow generation is particularly impressive, showing that they are not just making money on paper but generating actual usable cash. This cash flow is crucial for their ability to pay dividends and buy back shares, both invest. Friendly Actions, however, the slight decline in gross margins is a point of caution. While they are offsetting some of this with productivity and pricing, we need to watch if this trend continues. It suggests increasing cost pressures are at play. The difference between reported and core earnings also warrants attention. While the 20% jump in net earnings is exciting, it is important to remember that a significant portion of this comes from items they have identified as incremental restructuring, charges the underlying growth in their core business. While still positive, is much more modest in conclusion. Procter & Gamble remains a fundamentally strong company with a diversified portfolio and effective management of market and operational risks. Their ability to translate brand equity into pricing power is a significant competitive advantage. However, the increasing cost pressures and reliance on price over volume in some segments are factors to monitor closely. Alright, that is our deep dive into P&G's latest quarterly report. What do you think about their performance and their strategies for the future? Let us know in the comments below. If you found this breakdown valuable, please hit that like button and subscribe to Corporate Decoder for more insights like this. Don't forget to join our Discord community, linked in the description for more discussions and early access to our content. Thanks for watching, and we will see you in the next one.